Well, g'day. Thanks for joining me on the this week's live stream. It's our first anniversary this week. But it was actually last Sunday, I think, 16th of July. We're a year old, so yeah, it's a bit of a milestone. First of many years, I'm saying. It's been a fantastic year. We've really enjoyed ourselves, and I hope you've enjoyed the journey with us. So yeah, we've got Talking Finance this afternoon, and really part of the problem was that, you know, on Talking Finance and the podcast, we do a birthday for a musician, and this week's birthday was Carlos Santana, who turns 70 today, in fact, and it was the same a year ago. So we're starting to recycle our birthdays, which is both good and bad. Anyway, I figured, what the hell, we'll just do Carlos Santana every year on our birthday. What could be better? But we probably won't do Song of the Wind every year. Like last year was Song of the Wind, this year is Black Magic Woman. I just love Santana. I think he's great. But I don't think my enthusiasm for him is shared by everyone in the office here. That's life. Now, just remember, this is the disclaimer. Remember, the live stream and my answers are general advice and may not be appropriate for you. Now, if you've got any questions, just feel free to pop them in and we'll get to them straight away. Let's get it stuck into our first question. I have to have a sip of tea before we start this. First question is from Len. G'day, Len. Thanks for this. Now, he says, why is the US economy going down to the euro? I presume you mean the US dollar, which is indeed going down to the euro. I don't think the US economy is going down to the euro, but the US dollar is definitely going down. Is it something specific, or is it because of Donald Trump causing uncertainty? Business needs certainty. Indeed it does, Len. And I don't think Donald Trump is helping. Let's put it that way. But fundamentally, it's about the central banks, and you would think that interest rates going up in the US would cause the US dollar to rise versus the euro, since the European Central Bank is not putting interest rates up yet. Fundamentally, I think what's going on is that the US economy is weaker than the European economy. The European economy is much stronger, largely because of the ECB's actions, which is that they're still incredibly stimulatory. They've still got quantitative easing going, and they've still got the policy interest rate at below zero. So that's all very positive for the European economy, and money is flowing into the euro as a result, and flowing out of US dollars. And also recently there's been a change in the sentiment around the US dollar, the US interest rates, with a suspicion that that interest rates in the US will not rise as quickly as expected. So there's been a change in the in expectations, and that's kind of resulted in the US dollar coming off. And as I say, Donald Trump hasn't helped either, because it is terribly uncertain as a result of what he's doing, which, and as you say, business needs certainty. David asks, Alan, do you believe the ABS job numbers are actually believable? They seem bizarre to me. Well, indeed, they are incredibly strong, David. I'll just go through what they are. I'll just have to find them on my little machine here. But what we saw was a huge increase in full-time jobs. A huge increase. We got 62,000 full-time jobs and a decline of 48,000 part-time jobs. So even though the net employment figure that was reported this morning for June, was 14,000, that's a net figure of a big increase in full-time jobs and a fall in part-time jobs. And so what you've had back-to-back increases in full-time jobs totaling about 115,000. So it's been two very strong months for full-time jobs. And in fact, adding the two up, the 2 months of May and June, it's the strongest gain, 2-month gain for full-time jobs in 29 years. So is that kind of bizarre and not believable? Well, I think that the trouble, I don't think you can believe any single month. It's really only worth with this stuff, looking at the trend over time. And I think we are seeing strength in employment as a trend. The unemployment rate has stayed at 5.6% because participation has gone up 0.1%, so not much, but still enough to keep the unemployment rate where it is. And also, don't forget, the unemployment rate includes both full-time and part-time work, so the net figure is what's important for the unemployment rate. So look, I mean, I think what's happened, and I think I've reported this quite extensively in the Constant Investor, is that wages have decoupled from employment, and so whereas it's usually the case that the Reserve Bank and economists generally tend to focus on the unemployment rate, because the unemployment rate tends to have a direct impact on inflation. That's no longer the case. I mean, unemployment is down, employment's strong, but wages are still not doing much, and I think that's the central problem now. And I really do think that what has to happen is they kind of figure out a new way to judge what's going on, because it's no good just watching employment and unemployment anymore. That's not going to help with inflation at all, because wages are not responding to low unemployment. Not that Australia's unemployment is that low. I mean, we're in the mid-5s. America's in the mid-4s. Mid-5s is, it's certainly not full employment, that's for sure. But, as we saw this morning, quite strong employment growth. Do we believe it? Well, look, it's all we've got, David, to be honest. So, we have to go with it. David's got another question. Alan, what do you make of these criticisms of APRA? I haven't read it yet. You sent me a link. Yeah. Look, I'm critical of APRA too. I think they're making a big song and dance about not doing very much. I mean, honestly, they're trying to come up with unquestionably strong, in line with David Murray's financial system inquiry 2.5 years ago, and the phrase unquestionably strong, which is what Murray said the banks have to become and APRA has to be guided by, was never defined. Still hasn't been defined. What the hell is it? They've actually forced the banks to raise about $40 billion in extra capital, which is a fair bit, but the Tier 1 capital ratio has gone up, is up to now 10.5%. That means that the banks will be geared 9.5 times instead of 10.5 times. I don't really think that's a big deal. I don't think it's much of a change. I think the whole process has been almost ridiculous, to be honest. Angels on the head of a pin, like this huge kerfuffle, and regulatory oversight imposition on the banks that really is not going to make much difference, in my view, to whether there's a run on the banks in the event of a property collapse. I mean, what are we talking about here? We're talking about the banks being unquestionably strong in the face of a collapse of property. And I don't think a change in the Tier 1 capital ratio of the banks from 9.5 to 10.5% is going to make any difference to that whatsoever. Michael says, my question is ETF V managed funds. ETF versus managed funds. A friend of mine says that billions worldwide is now going into ETFs, and if there is a big sell later, that the ETF will or could lose value, but I do not understand if the underlying stock values in the ETFs hold their value. Well, you're right, Michael. I mean, an ETF is simply a cheap way of investing in a whole lot of companies at once. you can buy one security and you invest in, if it's the ASX 200 ETF, you're investing in 200 companies by buying one thing, and you don't pay very much in management, like just a few tens of basis points, maybe 10 or 20 basis points. So that's what ETFs are about. So if there's a loss of value in ETFs, it's because the market has gone down. So the stocks themselves, ETFs can't lose value and the stocks themselves hold their values, or vice versa, of course not. But there is so much money going to ETFs. My concern is that it actually turns into a rout. As the market turns and people start taking their money out of ETFs because they're worried, they want to put it into cash, which exacerbates the decline. So I do think we're coming up to the next. How can I put this another way? The next market downturn will be the first one where the markets are kind of dominated to an extent by ETFs. We haven't really seen it before. We don't know what will happen. I don't think anyone really knows what will happen. But for example, a lot of the big gold companies, gold stocks, are up to 18 to 20% owned by ETFs. That is to say that ETFs, I think it's mainly the Van Eyck Gold ETF, owns up to the takeover threshold of these companies. Now, what happens when they start to go down? People start pulling their money out of ETFs. The ETFs have to sell. And I think that there's a potential for a spiral to develop as a result of so many people owning ETFs. I'm not an investor in ETFs personally. I mean, I understand the attraction, which is low cost, and you get full market coverage. So therefore, your returns are going to match the market. You're not going to do worse than the market, but you're not going to do better. So I understand the benefit of that, and I understand why people like Warren Buffett suggest that retail investors invest in ETFs. They're not for me though, because I'd rather make a decision, firstly, about which stock to invest in, rather than just invest in them according to their size, which is what you do with an ETF. And secondly, if I'm going to invest in a fund, I want someone who knows what they're doing to pick the stocks. And so personally, I'm about managed funds and choosing my own stocks, not about ETFs, but I understand, as I say, why people do it. And I am concerned that the fact that so much money has gone into ETFs in the past few years means that the next downturn will be a different one, which nobody knows what will happen. It'll be quite unpredictable. John asks, Alan, if interest rates in Australia were to rise by 2% in the short to medium term, would this mean lights out for current valuations on banks and yield stocks, and of course property of all kinds? Not a great outlook for fund managers who run a yield-focused Australian equity strategy who would be forced to buy in such a scenario. Thanks. Well, indeed, if interest rates were to rise by 2% in the short to medium term, it would put a lot of pressure on valuations on banks and yield stocks. So I think you need to think about this in a couple of ways. Firstly, there's short-term interest rates, that is to say the cash rate, and long-term interest rates, that is to say bond yields. In relation to the cash rate, that's really where the discussion of the 2% come in, because the cash rate is currently 1.5%, and in the Reserve Bank minutes the other day, they had a discussion about what is the neutral cash rate. Now, the neutral cash rate is some sort of theoretical level of interest rates that central bankers talk about as being the level at which there's stable inflation and falling or low unemployment. That is to say, what you might call a Goldilocks cash rate. And they've come to the conclusion, more or less, although it's very uncertain, and they acknowledge the uncertainty, they've come to the sort of tentative conclusion that the neutral cash rate is now 3.5%, which is 2% above what it is now. And everyone got a bit excited about that and started saying, oh, the interest rates are going up 2%. Well, actually, that doesn't mean that at all. I mean, that's true that what they say is the neutral cash rate is 2% above what the cash rate is now, but there's no time frame on that. I mean, my view would be that there's going to be no change to interest rates in Australia, the cash rate in Australia, for at least 12 months. And then when it does go up, it'll go up very slowly. So there's, it's true that John Edwards, the former RBA director, said the other day that he expects there to be a 2% increase in cash rates. That is to say 8 rate hikes of 0.25% each, that's what he said. But he didn't put a time frame on that at all. I see that he's come out again today saying, or yesterday saying, basically reinforcing what he said, which is there's going to be another 8 rate hikes. That's true. But look, it'll take a while. And in any way, the cash rate is not what influences the valuations of yield stocks like banks and property. It's the bond rate that does that. And the reason that the banks and the yield stocks all went up over the past few years, not this year, but previously in 2014-15, was because the bond yield went down. And so when bond yields fall, yield stocks tend to rise because the yield is adjusted downwards. I think we are in a situation where bond yields are going to rise. They haven't actually, lately they've been going down, partly because of a bit of renewed pessimism, in particular about the US economy, also Australia. So we've seen bond yields come down a bit, but I think over the long term we're likely to see rises in bond yields, and that is going to put a downward pressure on bank valuations, it's true, and other yield stocks. Nevertheless, I mean, I think you've got to look at individual stocks, which and the individual circumstances of each company and each property are more important than the overall situation. Although, obviously it's better to have a tailwind than a headwind from interest rates. So I do think that as a result of bond yields rising over the next few years, I suspect that the yield stocks like banks and so on will have headwinds. But one headwind that has been removed from the banks this week has been capital, because APRA has declared that it's all over, it's fine. No more capital required because 10.5% is kind of basically, they're all there already. So that was one headwind that the market thought was there and has been removed, and that's why you've seen the banks' share prices go up so much in the past couple of days. We saw 3 to 4% yesterday and another 2 to 3% today. Let me have a look. I mean, they're all up a fair bit today. The banks, ANZ's up another 2.6% today. Westpac 2.3%. So look, we've seen big 5, 6, 7% gains in the past couple of days from the banks, all because that capital headwind has been removed, and it was factored into the share prices. But look, I mean, Telstra's another yield stock. I reckon you should stay away from that. I mean, it's in trouble because of the NBN, and property stocks, in particular retail property stocks, are in trouble because of Amazon. And so, although headwinds and tailwinds are important, what's going on with each individual stock is more important than that, in my opinion. Speaking of Amazon, Michael says, hi Alan, with the arrival of Amazon et al., do you think Australian listed retail business valuations are overstated, or is it already priced in? And if so, is there a potential flow on to retail property and shopping centres? Look, there are a few brokers and fund managers have come out and said that the sell-off of retail stocks and property REITs, shopping centre companies, in anticipation of Amazon is overdone. A lot of people are saying that. A lot of the analysts are saying that it's overdone, and they're all looking a bit cheap. And some people are saying, "Oh, look, it's going to take Amazon years to get going in Australia. You don't really have to worry about it." And that may or may not be true. My view is I wouldn't touch them, to be honest. There's so much else there's so many other good things to invest in that haven't got something like Amazon hanging over them. Why would you take the risk? I mean, the gains, it's just too much risk in my view. I don't think investing in JB Hi-Fi, Myers, Vicinity Centres, Centre Group, all these stocks, I don't think the returns are sufficient to repay you for the risk you're taking, for the disruption that's coming. I mean, clearly these stocks, these companies are being disrupted. The outcome is unpredictable. They may be okay. It may take longer than expected for Amazon and the other online businesses to make inroads onto them. But why take the risk? To be honest, I mean, I had an argument with somebody this morning who's a super fund manager, and he's saying, "Oh, you know, people are still going to go to shopping centres." Well, yeah, probably, but not as many people. That's the problem. I mean, it's not going to take much decline in traffic for regional shopping centres to start to have trouble, for the shops, you know, for the company, for the shops to suddenly start emptying out, for occupancy to fall to, you know, 70% instead of 90%, and for rents to come under pressure. I mean, of course, some people will still want to go to shopping centres, but not as many people will go to, in my opinion, not as many people will go to shopping centres. I mean, I had a thing in the overview the other day showing Amazon's idea, and this is a long-term idea, for some sort of vertical drone airport. I don't know if you guys saw it, but it was this amazing drawing that somebody got off Amazon, which showed sort of like a building and with slots for drones to come into, and the whole thing's run by robots with trucks backing into the bottom and the goods kind of being unloaded and shipped up to the slots for the drones to take to various customers. Now, maybe that doesn't come off in exactly that way, but I mean, these companies like Amazon, they are seriously out there in terms of automating the whole process of delivering goods to people. So look, I mean, I just think it's extremely risky, and I think that yeah, they've been sold off a bit, and in normal circumstances, you'd say they look a bit cheap, but it's not for me personally. Michael, again, would you distinguish between groceries, Woolworths and Wesfarmers compared to other retailers? Well, I mean, Woolworths and Wesfarmers have another problem coming at them, which is Aldi and Costco and Lidl, the discounters. I mean, those German, particularly the German discounters, but also Costco from America, are chomping into their market share as well. So they've got a problem not only with Amazon coming, but they've got this existing problem of Aldi, and also Lidl hasn't started here, but they're likely to come as well. So, yeah, I reckon those two are going to be under continuing pressure. I think that probably the business that's going to be come under most pressure is Metcash. It's not strong enough, doesn't have enough market share, and so I mean, you know, my local grocer is an IGA. Love it. It's a great little shop, and I go there all the time. But you know, it'll be a tragedy if they close. But I reckon they're going to be in trouble, to be honest. Robert has two questions. Alan, the US Fed has been dovish with rate hikes for various reasons, such as low inflation and weak productivity, which has caused the AUD, Australian dollar, and other major currencies to strengthen drastically against the US dollar, which has the Australian dollar up to 79 and likely to go over 80 cents shortly. What are your thoughts of the prospects of the RBA actually lowering rates to weaken the currency when household debt is at all-time highs? Given this will raise the ire of APRA and major credit agencies such as Moody's and Standard & Poor's, which have lowered the rating of Australian banks. Excellent question, Robert. Personally, I think you're onto something there. I don't think the RBA will cut rates anymore unless there's a real problem. I mean, you know, but I certainly don't think the RBA will cut rates only because the Australian dollar goes to 80. I mean, don't forget, it's just a few years ago the Australian dollar was at parity, and that was largely because the Reserve Bank had increased interest rates. The RBA actually did cut rates to get the dollar down below parity, but that was really because it had increased rates, which was responsible for getting the dollar above parity. I mean, I suspect the RBA this time would conclude that this is not all about interest rate differential, and that cutting the Australian cash rate by another 25 or even 50 basis points won't have any impact, won't make any difference to the dollar. If the dollar's at 80 or even 85, cutting Australian interest rates won't bring it down. It'll bring it down temporarily, maybe a bit, but not really fundamentally. There's something fundamental going on, and it's all about the US dollar and what's going on with the US economy. So the answer is, my view would be that there's no rate cut in prospect, but nor is there a rate hike in prospect for the same reason, which is that, you know, that would tend to turbocharge the Australian dollar, and, you know, they don't want to make the same mistake twice. I mean, that was a terrible thing that they did in putting rates up in 2011-12. It was premature, and what happened was, as a result of that, we lost the car industry, because the dollar went to parity, stayed at parity for a couple of years, and Australian manufacturing just fell over. So, you know, I think that was a terrible mistake, and I don't think they'll want to make that mistake again. So they won't put rates up, and they won't cut them for the reason you mentioned, which is that you know, we've also already got household debt at an all-time high, and in danger of losing our overall ratings. So that's why I think actually that there's going to be no change to Australian interest rates for another 12 months. What are your thoughts, Robert's second question? What are your thoughts that the RBA may lower rates to close to zero or negative to ensure the cash rate is less than the US federal cash rate? Many European countries are around zero, and some countries such as Japan have gone negative. I think it's a low probability but a possibility. Well, anything's possible, Robert, but I don't think that one is a probability, that's for sure. I don't think... history shows that Australia does not need to have interest rates below America's in order to achieve some sort of equilibrium. There's no necessity for that, and I don't think that's at all likely that there's going to be a need for us to reduce interest rates to below America's. There's definitely a risk premium associated with Australia, which allows our interest rates to be higher, and means that they kind of have to be higher actually, because of the risk premium associated with it. I mean, you're right that Japan in particular, but also Europe, don't have a risk premium. It's partly because they have such a high level of domestic savings, particularly in Japan. I mean, they have a colossal amount of domestic savings, which means that they don't need to attract foreign capital. Australia needs foreign capital and has to pay up for it. So that's why interest rates here will always be higher than America, because we've got to attract capital. Countries like Japan, and to a lesser extent Sweden, Switzerland, other European places, are not in the same situation. David says, Alan, do you agree with Ed Luce of the FT that the US has become ungovernable with the apparent failure of Trump's legislative agenda? Yeah, look, it's close, isn't it? I mean, ungovernable is a big statement. I think it's probably not governable by Donald Trump. I'd say that. I mean, it's governable by someone else, but I think that part of the problem is that the Republican Party has lost its way. They don't really know what they're doing. They don't have a kind of an agenda. They don't have a philosophy anymore. So it's becoming difficult to govern the place. But look, I think it's going to be interesting to see how it unfolds. Really, I mean, will Trump last 4 years? Will there be? If he was impeached or resigned or whatever, would it become more governable with Mike Pence in charge? I don't know. Clearly, Mike Pence is a slightly more conventional politician than Donald Trump, so he might be able to do better. But yeah, look, I think it's a good question, and I haven't read the piece yet by Luce, but I will now. Thank you, David. Judy says, just getting back to last week's question from Judy. She asked about Transurban regarding its financing. Yeah, look, they've just done a big refinancing. They've raised $1.1 billion to replace $900 million credit line. I don't think that's a big deal. I really like Transurban. I own some myself. I think it's a fantastic business. I mean, apart from the kind of the roads that it already owns here, and the widening that they're doing of the Tullamarine Freeway here, which is the original City Link that the company was floated on, they've got some tremendous prospects. I mean, the Westlink, the Westgate Tunnel in Melbourne will carry a lot of traffic, I reckon. And they're underway with that, and also the express lanes in the US. They've got these things in the interstate. There's the Interstate 95 down the east coast of the US. Now, Transurban, as I understand it, have got two sets of express lanes around Washington, which basically help people get to work. And they've got this system, it seems, of a differential pricing, so people can drive in the slow lane, but if you want to get there faster, you have to go in the express lane, which Transurban owns, and they charge for the express lane. So it's just a service, help people get to work faster, but it's a tolled express lane, which is really interesting. And I think that there's clearly going to be a lot more of that through the US, and Transurban's getting itself into a good position to own them. So I think that there's a tremendous potential for growth for Transurban in the US. Not just the express lanes, but once it starts to get to know the American market, it can possibly start to really do some good there. I think it's a fantastic business, and with potential growth not just here but also in the US. Gavin says, hi, at what price do you feel Telstra would be a buy? I don't really, look, I'm not a sort of a trained analyst, so I couldn't give you a price like that. All I'd say is it's a fair bit less than it is now, in my opinion. To be honest, I'm not interested in Telstra. I mean, look, it depends. It entirely depends what you're doing here. I mean, if you're buying Telstra as a yield stock, you want income, then the question is, how much do you think that they're going to cut the dividend by? I reckon there's a chance they won't muck around. When they cut the dividend, which they will do, it won't be by a little bit. I mean, they will cut the dividend in half, I'd say. In which case, if you're after a yield, you'll be paying a fair bit less than you're paying now to achieve the same kind of yield. I would have thought, in anticipation of a cut in the dividend. So look, I'd wait. I mean, I wouldn't touch it until they actually do it. Yeah, I wouldn't touch Telstra personally. I wouldn't. I would wait to see what happens see what happens when they cut the dividend. I'm not sure when they'll do it. It probably won't be too long, and you'll see where it settles and where the yield settles, and then you can make an assessment. But I think Telstra's got a few years of pain ahead of it in general. You know, I think it's going to take a while, not just for the dividend to settle down, to find out where they land on the dividend, but where they land on their market share. I mean, how much of Telstra's market share is TPG and the rest of them going to take? Optus, Amasim, all these businesses that are going after Telstra as NBN resellers. I mean, they are really going to, and I think it's really, the jury's completely out on how much of their market share Telstra's going to be able to defend. I mean, are they going to be able to defend 50% market share? I don't think so. And so where are they going to settle on their market share in Australia? I just don't know. I think it's really uncertain. Priyanka says, what are your thoughts on the Australian lithium sector, and in particular Galaxy Resources? The lithium sector has been on the decline since early this year. What do you foresee in the next 6 to 12 months? Yeah, it's interesting, isn't it? I mean, the thing about lithium is that it's clearly entering, you know, a big phase of growth in the usage of lithium. You know, electric vehicles are starting to approach a tipping point, and so are grid batteries. There's going to be a lot of those, and a lot of household batteries. So there's, you know, the three big uses of lithium, which is electric vehicles, home batteries, and grid batteries, are clear. That is clearly in place and will continue on. But there's also a big scramble for supply as well. So to be honest, I've been trying to keep up with it. I haven't actually looked at it for a while. Let me have a look at what Galaxy's been doing. I mean, Galaxy, I think, is Australia's #1 lithium stock, and along with Orocobre, Galaxy Resources stock's down a fair bit, isn't it? Look at that, it's down by half. Heavens above! I forgot. I didn't realise that it's down by half this year. Orocobre, which I used to own and don't anymore, is also down a fair bit. So look, I think everyone's kind of readjusting their thinking about lithium, that that the price, you know, is going to come down as supply increases, even though demand is there. I'll see if I can find some. I'll include some lithium research in the overview on Saturday. Priyanka, so check out the overview, and I'll see if I can find some lithium research and Galaxy Resources research to put in there for you, so you can have a look at what the analysts are saying about demand and supply. I think a final question here from Duncan: what are your favourites in the healthcare space? X, CSL, and COH, Cochlear. Do you have any thoughts re Pro Medicus, Nanosonics? Look, I think Pro Medicus is an interesting business. I've recently interviewed LBT Innovations, which is a company in Adelaide, which is applying artificial intelligence to pathology. I like the sound of that business. I'd suggest you have a look at that. And I also interviewed Brent Barnes of MediBio. Now, that's another interesting business. They say they have an objective diagnosis for depression and anxiety. So they're interesting. We've got on the website.
Brent Barnes is from LBT.
Brent Barnes is LBT. That's it. Whoops. I can't remember the bloke from. MediBio is Jack Cosentino. That's it. And he lives in Minneapolis, which has been in the news lately. Not just because Buffy comes from there, but also because of that terrible murder. But anyway, LBT is Brent Barnes. MediBio is Jack Cosentino. Now, we've also got David Blake's picks in the Constant Investor. Let me just have a look at what they are. David Blake runs a newsletter called, what's it called? BioShares. where he analyses all these all the health care stocks. And let me just find what his picks are. David Blake, come on, David Blake, where are you? Can't find him. Where is he? Seems to have dropped off. I seem to remember David actually picked innate immunotherapies briefly and got out of it before it crashed, which was good news. Oh, I'm having trouble finding them immediately, but go onto our stock picks and you'll find, hopefully find David's bio. They have dropped off. Okay, we'll get them back there. Goodness me, David's gone missing. Anyway, so give us 24 hours and we'll get David Blake's picks back, and you can check out those. The MediBio one, Jack Constantino for MediBio is next Monday, CEO interview, and we've got a few things coming up next week which will be worth looking for. We're asking the fund managers what their view of the Australian dollar is. I'll be talking to Warwick McKibben, who's got some interesting views about the dollar and the interest rates, and the neutral cash rate and so on. So that's good. And after next week after next, I'm going to have a week off. So just the 1 week's break. It's been a pretty big year. Need a bit of a rest. And the person who's going to replace me here, doing some interviews and writing the overview, is Stephen Main. So I hope you enjoy that. Thanks for your company. It's been great.
David Blake's picks.
Oh, David Blake's picks we have here. Oh yeah, MicroX. MicroX is the business in Adelaide that's making mini X-ray machines, which you'll find on our site. We've also interviewed them. Bionomics and Osprey. So they're some stocks to look out for in healthcare. So Bionomics, Osprey, MicroX, MediBio, LBT Innovations. There's 5. But it's hard to go past CSL, I must say. What a fantastic business CSL is, honestly. Okay, thanks for that. It's been great. I'll be in your inbox on Saturday morning. Until then, I'll see you.